Hello and welcome back to All Things Money. I'm your host, David Blain. During today's show, we're talking all about capital gains, tax rates for capital gains. First segment, we kind of talked a little bit about what they are, introduced some of the taxes. Last segment, we really got into the numbers, showing how long-term capital gains in the highest bracket can easily get into the low 30%, and short-term capital gains are well above 50%. Now, for taxpayers in the lower tax bracket, married filing jointly, whose taxable income is below $72,500, your capital gains rate is 0, which is wonderful. That's great. We're all for that. So what we want to do this segment is talk about some ways that you can look at the tax code and you can legally and ethically structure your affairs so as to minimize your taxes. Now, if you recall, I said that the tax rate on capital gains, the 0, 15, or 20%, is based on your taxable income. The three, what I call stealth taxes, the 3.8% investment income, the P's limit, and the personal exemption phase out, they're not really, they kind of are stealthy capital gains tax. Those are all based on your adjusted gross income. So if you recall, on the front side of your 1040, you list all your income, and then you get a few adjustments to that income. And in fact, most people, if you're not self-employed and some other things, it's very hard to fill in those boxes and get adjustments to income. There are things like the self-employed retirement plan, contributions, self-employment tax deduction, some of those things. So the trick, one of the things to do to lower your capital gains rate, number one, is to try to lower that adjusted gross income. So that means that it will help eliminate some of those taxes that are based on your adjusted gross income. And so one of the things to do is making deductible contributions to either IRAs or 401ks. If you put it in your 401k, it never shows up on your tax form. It's one of the greatest benefits still out there. $17,500 is the normal limit, plus there's a $5,500 catch-up contribution if you're over 50. Things like moving expenses, business deductions, and losses. Capital losses. We're very big in our firm about what's called harvesting capital losses. So if you purchase a mutual fund, let's say in January and for $20, and it goes down in February for $15, sell it. Take the capital loss. Buy something back similar. So if you have $20, you put it in, it goes down to $15. Take the $15, you sell it. Now you've created this paper $5 loss. You have $15. Take it and buy $15 worth of something similar. You can't buy the exact same thing. It's called a wash sale. But anyway, buy something similar, and now you have this paper $5 loss. So at the end of the year, let's say it recovers. You originally paid $20, and by the end of the year, it recovers all the way. It dropped down to $15, it goes up to $25, and let's say you sell at that point. So now you have a $5 gain in that security. Oh, but wait, in February you sold it originally for a loss, for a $5 loss, and so now your capital gains for the year is 0. That's the point behind what's called tax loss harvesting. It's a great, great strategy. Anyway, so number one, lower your adjusted gross income. Look at ways to lower that adjusted gross income. There's a lot of things in the tax code that are based on adjusted gross income. It's like I tell people, once that income gets on your 1040, that's your tax form, there's not a lot you can do. Keep it off the 1040 as much as you can. Okay. The number two way to minimize your capital gains is take advantage of what I call these buffer zones in the tax code. So, for example, if you take a retired couple that has maybe $70,000 of adjusted gross income before capital gains and about $30,000 of itemized deduction, they've got about $33,000 of difference before they get out of that 0% tax bracket. And so if they have some gains in their portfolio, what we try to do if people are, especially people that are living on their income, is every year you look at where their taxes are and you sell enough stuff in the capital gains to take them right up to that $72,500 taxable income limit, and so all of their capital gains are tax-free. So if you have somebody, let's say they need, to sell things to live on, they need the money, look at the taxable income and sell enough in that year to use up all the 0%. It's a great strategy. It takes planning, it takes forethought, but for people that have adjusted gross income below that $72,500, it's a great strategy. Especially, let's say you think your children are going to go to college in a few years, or you're going to buy a house or something, and you're going to need to sell a big chunk of things. Well, sell it a couple years ahead of time and take advantage of that 0%. Split it up so that each year your tax is 0%. It's a great strategy. Another thing, if you're charitably inclined, is give that stock to a charity. A charity can sell it. A charity doesn't pay tax, and so you could take that Apple stock that you paid 50 cents for, that's now worth $400 or $500 a share. If you were to sell it, you'd pay capital gains on that whole amount practically. If you give it to a charity, they can sell it tax-free, and you get a deduction for the value of it. So let's say that you paid 50 cents for it and it's worth $500, and you would pay tax on $499.50. If you give it to a charity, let's say we're going to give them $500 anyway. Give them the Apple stock, give them a share, and you get a $500 tax deduction, and they get to sell it, and they don't pay any capital gains rate. Hold on to it. If you don't need to sell it, remember, at death, your heirs will get a step up in basis. Now, we're talking about money in a taxable account. IRAs, 401ks, IRAs, 401ks, that's a different story. But if it's in a taxable account, that $500 Apple stock that you paid 50 cents for, when your heirs inherit it, their basis becomes $500. The basis gets reset. Certain things, you could do an installment sale. If you have a piece of property or something, you could do an installment sale and break up the proceeds of that sale into chunks, once again keeping them all in that 0% tax bracket. Well, that's a lot of information. I hope that's been helpful. If you have taxable assets, be aware of the capital gains taxes and how they work. So for All Things Money, I'm your host, David Blain. I hope you enjoyed the show, and we'll see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.